Loss aversion is a powerful psychological bias that affects many investors, causing them to hold on to losing investments longer than is financially wise. This tendency stems from the discomfort people feel when facing losses, which is often more intense than the satisfaction derived from gains. Understanding why it's so hard to sell investments, even when they're underperforming, is essential for making more rational financial decisions. By recognizing the influence of loss aversion, investors can take steps to overcome it, making better choices that align with their long-term financial goals. Acknowledging this bias is key to improving investment strategies and achieving success. In this video, we will talk about understanding loss aversion, why it's hard to sell investments. So make sure to watch the full video. 1. What is loss aversion in behavioral finance? Loss aversion refers to the psychological phenomenon where individuals feel the pain of a loss more intensely than the pleasure of a similar-sized gain. In the context of investing, this means that the emotional discomfort of losing money often outweighs the satisfaction of making a profit. Behavioral finance explores how loss aversion can distort decision-making, causing investors to hold on to losing investments for too long in hopes of avoiding the realization of a loss. Understanding loss aversion is crucial for investors as it highlights the impact of emotions on financial decision-making and provides insights into why certain investment behaviors occur. 2. The psychology behind holding losing investments. One of the main reasons investors struggle to sell losing investments is the psychological barrier created by loss aversion. When a loss is experienced, it triggers negative emotions such as regret, guilt, and disappointment, leading investors to irrationally hope that the investment will recover rather than cutting their losses. This behavior is driven by the desire to avoid the discomfort of realizing a loss, even if holding on to the investment may only prolong the inevitable. Understanding this psychology can help investors confront the emotional difficulties of selling a losing investment and make more rational, objective decisions based on long-term goals. 3. Emotional attachment, a barrier to selling. Emotional attachment to investments can also be a significant barrier to selling, particularly when investors feel personally connected to their stocks, bonds, or assets. Often, people invest in companies or sectors that resonate with their values, beliefs, or experiences. This emotional bond can cloud judgment, causing them to hold on to losing investments even when it no longer makes sense financially. Whether it's a sense of loyalty or the fear of admitting a mistake, emotional attachment often hinders the ability to let go of investments that are underperforming. Recognizing this attachment and separating emotions from investment decisions is vital for better financial outcomes. 4. How loss aversion influences decision-making. Loss aversion significantly impacts decision-making, as people are more likely to avoid making choices that could result in a loss, even if the potential gains outweigh the risks. In investing, this tendency can lead to holding on to declining investments longer than necessary, hoping that market conditions will improve. The fear of locking in a loss often leads to missed opportunities for rebalancing a portfolio and investing in more promising assets. Loss aversion can create a bias toward avoiding risk, even when taking a calculated risk could ultimately lead to greater financial benefits. Understanding this influence can help investors make more informed, objective decisions. 5. The impact of loss aversion on portfolio performance. Loss aversion can have a significant impact on the overall performance of an investment portfolio. When investors are reluctant to sell underperforming assets, they miss the opportunity to reallocate capital into higher-performing investments. Holding on to losing positions too long can also result in unnecessary risk exposure, especially if the asset continues to decline in value. Over time, these emotional decisions can reduce the overall growth potential of a portfolio, leaving investors stuck with suboptimal returns. Recognizing and addressing loss aversion can help investors rebalance their portfolios more effectively and enhance their long-term financial success. 6. Overcoming the fear of realizing losses. Overcoming the fear of realizing losses is a key step in managing loss aversion and making sound investment decisions. The fear of admitting a financial mistake or the discomfort of realizing a loss can cause investors to hold on to losing investments for far too long. However, acknowledging that losses are a natural part of investing can help mitigate this fear by adopting a more rational long-term approach and focusing on the potential for future growth. Investors can overcome the psychological barrier of loss aversion and make more strategic decisions. It's important to recognize that realizing a loss allows for the possibility of reinvesting in better opportunities. 7. The role of cognitive dissonance in loss aversion. Cognitive dissonance plays a significant role in loss aversion by creating a psychological conflict between an individual's beliefs and their actions. When an investor holds on to a losing investment, they may experience discomfort because their current decision contradicts the belief that their investment should grow or succeed. To reduce this discomfort, the investor may rationalize holding the loss or ignore the signals that suggest the investment should be sold. This mental conflict is a key factor in why loss aversion is so powerful. Understanding cognitive dissonance helps investors recognize when their emotions are clouding their judgment and encourages more logical, less biased decision-making. 8. Practical strategies to manage loss aversion. Managing loss aversion involves practical strategies that help investors make objective decisions despite their emotional biases. One effective approach is setting predefined rules for when to sell an investment, such as cutting losses after a certain percentage decline, or when specific financial goals are no longer being met. Another strategy is regular portfolio reviews, which allow investors to assess their positions without the influence of short-term market fluctuations. Additionally, seeking professional advice or using automated investment tools can provide a more rational, data-driven approach to decision-making. By implementing these strategies, investors can reduce the impact of loss aversion and make better financial choices. 9. Lessons from successful investors on letting go. Successful investors often emphasize the importance of knowing when to let go of losing investments. They understand that holding on to an underperforming asset can prevent them from capitalizing on better opportunities. Legendary investors like Warren Buffett have long advocated for focusing on high-quality assets and selling when an investment no longer aligns with their long-term strategy. Lessons from these experienced investors teach that the ability to accept losses and reallocate capital effectively is essential for long-term success. By learning from these examples and applying their principles, investors can better manage their own loss aversion and improve their financial outcomes. 10. Why recognizing loss aversion is key to better investing. Recognizing loss aversion is crucial to becoming a better investor. Awareness of this psychological bias helps individuals make more informed, less emotionally driven decisions, allowing them to avoid costly mistakes. By acknowledging the tendency to fear losses and understanding how it influences their behavior, investors can take steps to counteract its effects, such as setting objective investment goals and adhering to a disciplined investment strategy. Ultimately, recognizing and addressing loss aversion empowers investors to make decisions based on facts and analysis rather than emotions, leading to more consistent long-term success in the markets. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.